Okay, so hello to everyone. We are going to start with our session in around 5 minutes time. I hope you all are doing great. Okay, so by now I expect that all of you have actually completed everything, and there is nothing pending. And as per the planner, if you started on time, I hope that you have completed each and everything. Okay. Uh, Now we are entering the last phase of our preparation. We are entering into the last few days, okay? The last days which are very crucial with regards to your passing of the exam. These days ideally must be spent in practicing everything, okay? And you must be very focused and you must invest maximum possible time in covering the content. You must not waste any single minute at all. Okay. I did send agenda for today's session that was sent to everyone. So I am hopeful that you all did check the agenda actually. We have to discuss certain concepts. We have to discuss some theory today and some concepts, and then I will ask you people if you recommend something to be discussed. One thing that I want to discuss today is how actually we will use the Modigliani and Miller proposition number 2. Okay, so this is the first thing that I want to discuss with all of you, and it is about Modigliani and Miller's model. If you actually check the recent formula sheet, have you all downloaded the recent formula sheet? Have you guys actually downloaded the recent formula sheet, the most recent one? There are slight changes in the sheet. Okay. One change is about how we have to apply the Modigliani and Miller model. So I have prepared a small file over here, which is in front of you, which will help you know, which will guide you how we apply M and M proposition, and also why and when to apply it. So first thing to share with you is this formula. Now in the most recent formula sheet, you will find Modigliani and Miller proposition number 2 with text in two forms. The first form is as it used to be, and then the above formula is rearranged as follows. How many of you are aware about this change? Are you guys aware about the change in this particular formula? If you check the most recent sheet, you will find that the formula has changed. Okay, they have rearranged it, and after rearranging, they have given another formula. It is not different, it is same. But why have they done so is that because in exam questions, you actually need to use a spreadsheet now. It is not a paper-based exam. So since you have to use the spreadsheet, it was very difficult for the students to use the spreadsheet and find the ungeared cost of equity at times. So we will discuss the application, how you actually apply this specific formula in your Excel file. Okay. So let's start in sequence. The first thing is when to apply. Why will we apply M&M proposition from the formula sheet? When will we apply it? How will we know that we have to apply it? So the thing is very simple. Number one, when asset beta reflecting the business risk or equity beta reflecting business risk and financial risk is not given, and hence we cannot use capital asset pricing model. So the first condition or the first hint in your question when you will be applying M&M proposition is that in the question you will not find asset beta, you will not find equity beta, and hence it is not possible for you to apply capital asset pricing model. Agreed? Otherwise, we can use the capital asset pricing model, that is risk-free rate of return plus beta multiplied by risk premium, to find cost of equity. But for example, in a question, you need cost of equity, but there is no information about beta asset or beta equity, which is needed in capital asset pricing model formula. So this is the first condition that you will look into the question. If the question does not have any sort of details about asset beta and equity beta, then you have to move to this particular formula. This was condition number one. Okay, this was condition number one. And now, what is condition number two? We are given with geared cost of equity reflecting business risk and financial risk, but we need ungeared cost of equity to discount the cash flows. This is needed in adjusted present value questions. We know that in adjusted present value or APV questions, in adjusted present value questions, what is our initial assumption? In adjusted present value questions, our initial assumption is that the project is 100% equity financed. There is no debt, there is no loan, and hence there is no financial risk. So the only risk is your business risk, and you have to calculate your cost of equity based on business risk. Okay. So for example, in an adjusted present value question, if you are provided with geared cost of equity and you need ungeared cost of equity, geared cost of equity means a cost of equity that takes into account or reflects the business and financial risk both. But you need ungeared cost of equity. And when we talk about ungeared cost of equity, it reflects business risk only. So for example, if you need a cost of equity which reflects the business risk only, we will use this formula. So condition number one is compulsory and condition two. Okay. When condition one and condition number two are present, you are going to apply M&M proposition. Or condition number one and condition number three are present. And what is condition number three? We are given with geared cost of equity of a proxy company, but we need to calculate our own geared cost of equity to discount the cash flows of a project. Sometimes in a question, you are given a proxy company. You are given the cost of equity of a proxy company. Cost of equity of a proxy company will reflect its business risk and financial risk. Now you are making an investment in a project which is similar in business terms to what the proxy company is doing. So you need business risk of the proxy company and your own debt to equity ratio for your own financial risk. So you will use the geared cost of equity of the proxy company, ungear it. Ungeared cost of equity will reflect business risk, and re-gear it using your own debt to equity ratio. Okay. So these are the conditions which will give you a hint, which will give you an idea about actually when you have to apply Modigliani and Miller's proposition. The concepts are same as beta asset and beta equity. You all know beta asset reflects business risk, beta equity reflects business as well as financial risk. Likewise, geared cost of equity reflects business and financial risk both. Ungeared cost of equity reflects the business risk only. So if condition 1 and 2 are present, or if condition 1 and 3 are present, you are going to apply M&M proposition or M&M formula. Are we clear about when to apply the formula? These are the conditions under which you will apply the formula. Now, under condition number 2, your prime objective is to calculate the ungeared cost of equity. Because in adjusted present value questions, your first assumption is that the project is 100% equity finance. Under option number 3, your purpose is to calculate the geared cost of equity. But for that geared cost of equity, you have a proxy company which you ungear, you calculate ungeared cost of equity and you regear it. Very similar to what we did in asset beta and equity beta and the capital asset pricing model. Now, I have written some more points under 2, that is in 2. We need ungeared cost of equity which reflects business risk only, since in adjusted present value questions, in order to calculate the base case net present value, we initially assume that project is 100% equity finance and hence there is no financial risk, there is no debt. Under 3, that is this case, we are investing in a business which has different businesses than our own. We will use proxy companies' geared cost of equity and ungeared it and regeared it according to our own debt to equity ratio. This is when we apply the formula actually. Now coming to the real area, that is the application of the formula. Now, when we have to apply the formula, we have to remember that there is a geared cost of equity which includes financial and business risk, and ungeared cost of equity which includes the business risk only. And the formula in your new issued formula sheet looks like this. So if I take the second rearranged format, we can take ungeared cost of equity common. And if I take ungeared cost of equity common, I can write it like this, correct? KE as it is, plus 1 minus tax rate as it is, KD as it is, VD as it is, VE as it is, equals to sign as it is. Ungeared cost of equity is present over here and it is present over here as well. So I take ungeared cost of equity common. If I take ungeared cost of equity common, I have 1 plus 1 minus T multiplied by value of debt over value of equity. Okay. Now what we do is that we can calculate, for example, if we have this data and we are supposed to calculate ungeared cost of equity. So we have geared cost of equity, that is 11%, tax rate 30%, value of debt 250, value of equity 450, and cost of debt 5.5%. So we can calculate the left hand side. Left hand side means this side of the equation, it is KE plus 1 minus tax rate multiplied by KD over VD over VE. KE plus 1 minus tax rate multiplied by KD over VD over VE. So we solve this entire side. And on the right hand side, we have 1 plus 1 minus tax rate multiplied by value of debt over value of equity. Ungeared cost of equity remains as it is. Now it becomes left hand side is equals to ungeared cost of equity multiplied by right hand side. So left hand side divided by right hand side will give me ungeared cost of equity. I hope everyone has understood this. If there is any doubt, you can discuss with me right now before I proceed. Okay, do carefully try to understand how we actually did what we did. Okay, Ritik, you can have a look and let me know what specifically you don't understand. I have just explained everything, but if there is any doubt, the formula sheet will be given to you in your exams when you are on your CBE portal. While there is a question, the formula sheet will be on the left bottom corner somewhere. Okay, giving a 1 minute time for those who just joined to read it again. Yes, we have to put in the values. Rearrange formula is already given. You don't need to rearrange yourself. It is already given in the question. All you have to do is that simply solve like what I did right now. Exactly same. Just do what I did. Okay, everyone is clear now? I have also shared the formula sheet which you can look into and maybe discuss with me if there are any doubts later on. Shall we proceed? Okay, so this was the first thing that I wanted to discuss with all of you today. And I have also shared this sheet with all the students who are with me on WhatsApp. And if you are someone who did not get this Excel file, you can WhatsApp me on this number and I will be sharing it with you. Also ask the support staff at VIFHE to add you to the public WhatsApp group. I am giving 1 more minute before I proceed. All right, so this was the first thing that we needed to discuss today, and we did discuss today. It is very important since it is a recent change in the formula sheet. There are high chances that it is going to be tested in your exam paper as well. Yes, let me show you this specific value as well. Okay. So this was the first thing that we were supposed to discuss today, and we did discuss it today. Moving to the second thing is dark pool system. Okay. How many of you are aware that there is something in the syllabus known as dark pool, or have a good understanding of what dark pool is all about? Do you all know what dark pool is all about? Do you guys know what a dark pool trading system is all about? It is part of your theoretical area that I need to discuss now. Are you all aware of this dark pool? Okay. Again, this file is provided to you and you can access it. So to make things simple, to make the understanding of the dark pool area simple, I have broken it into 4 steps. And let's discuss each step one by one. Do remember that you don't need very in-depth understanding, but yes, you must know something so that you are able to write it. Now, point number 1. Let's say that there is ABC pension fund, and ABC pension fund has a very large block of shares of XYZ Limited that it wishes to sell due to some reason. Now, this pension fund has 2 options. Number 1, option 1 is to go to the normal stock market. So what will happen if they go to the stock market? Since they have to sell a very huge block of funds, like there are many shares, there will be a high chance that one single buyer will not buy everything. There will be multiple buyers, and on the stock exchange, the buyers and the sellers come every minute, okay, on the window. So if ABC pension fund sells all their shares of XYZ Limited on the normal stock exchange market, what is going to happen? Go for the normal process of selling in the market. If this happens, there will be several buyers buying a small quantity of shares. Obviously, as I stated, that there are going to be a lot of individuals, and none of the individuals will have the capacity to buy everything. So for example, if you have 100 units, someone will buy 5 units, then someone else will come and buy 10 units, then someone else will come and buy 20 units. Agreed? After each sale, there will be a reduction in the price of shares as the quantity gets diluted in the market. Now, the market gets a signal that a large pension fund is divesting, diluting their investment in XYZ Limited. So there might be something wrong in XYZ Limited or its future prospects. That's why ABC Pension Fund is diluting it. They are selling their shares of XYZ Limited daily. It might be true, but it might also be wrong. But what will happen that after each sale, due to uncertainty, due to selling of shares of ABC Limited, of XYZ Limited daily, there will be a reduction, most likely a reduction in the selling price of the shares. So how ABC Pension Fund saves themselves from this reduction in selling price? Because if there is a very slight dip, even a very slight dip in the selling price, there is going to be a huge loss that ABC Pension Fund is going to suffer from. So they can go for dark pool trading. Now, what is dark pool trading? We will understand later. But everything relevant to point number 1 is clear. I'm not going to repeat it again, and I'm going to be a bit quick today because I expect you all that you all are done with everything, and these are the last few days, so we cannot waste time. Anyone who needs recording, yes, the recordings are going to be on YouTube. These Excel files are going to be provided to you, but during class, I'm not going to be very slow. Let me know if bullet number 1 is clear. Okay, now bullet number 2. Just like ABC is a pension fund who is selling a large quantity of XYZ Limited, there might be some other pension fund, there might be someone else willing to buy XYZ Limited. Everyone don't think in the same direction. There might be some reasons for ABC Limited to dispose of their shares in XYZ Limited. There might be some other reasons for DEF Limited to buy those shares. So they want to buy a large block of shares. Now again, they have two options. Option number 1 is to go to the normal process of buying from the market. Again, if this happens, there will be several sellers selling small quantity of shares. Apart from ABC Limited, there are going to be, apart from ABC Pension Fund, there are going to be a lot of other people as well, correct? So DEF, if for example, DEF wants to buy 100 shares, someone is selling 10 shares, they will buy. Someone is selling 20 shares, they will buy that as well. Someone is selling 5 shares, they will buy that as well. That will give a signal to the market that there is something good coming ahead with respect to XYZ Limited, and there are chances that the share prices are going to rise. So after each purchase, there will be an increase in the price of shares as the quantity reduces from the market. So if the prices increase, it is harmful, or it is going to have an adverse impact on DEF. So what DEF can do is go for dark pool trading system as well. So is this point too clear now? Okay, we are going to understand what is dark pool, but first try to understand that there are two markets. One is the open market, the normal exchange, and the second is dark pool. The first option is not a viable option for either ABC Limited or DEF Limited. ABC Limited, it is not beneficial because if they keep on conducting the same activity of buying selling small quantities, there will be a price reduction, and opposite goes for the other company. Then comes step number 3. Step number 3 is to go dark pool. Okay, now what is dark pool? Dark pool can be thought of as a private room where sellers with large block of shares and buyers willing to buy a large block of shares come across each other. The transaction gets done. Since there is no signal original market till the very time transaction was conducted, there is no change in price. So you can think of a dark pool that it is like a room where someone who is conducting transaction like 1 and someone who wants to conduct a transaction like 2 are operating, or they are in a single place at a single room. The seller and the buyer are going to conduct transactions between themselves. Okay, and since it is not going through the proper normal routine stock exchange procedure, there is no actually signals going into the market. Okay, so you can think of it as a private transaction between two parties, but actually it is not a private transaction because it will still happen in the normal manner, just that like it is a separate area. You can say that there is a dark pool area, and whenever you have to conduct a transaction of large block of shares, you go there. Okay, and then once the transaction is conducted, once everything is conducted, since the shares are going are listed, since it there are regulations, so after everything is done, after the seller sells the shares, the buyer buys the shares, everything has done, every trading activity is completed, ABC has sold, DEF has bought, they have to make a public announcement that there was a trading of XYZ shares between us, and due to that trading, now these shares belong to us and XYZ. So it will turn out to be a public information, but not immediately. Okay. There are some points about dark pool trading system as well that I have wrote over here. Number one, they are off exchange facilities that allow trading of large block of shares between anonymous parties. Okay, one thing to remember is that at point 3, in the dark pool, both parties are going to be private, which means that the buyer will not know from whom it is buying it. The seller will not know from whom to whom it is selling. They just enter a room. You think of it like this, that there is a very dark room in which you cannot see each other. You just whisper, or you just say, I want to sell XYZ limited company shares, and the buyer is saying that I want to buy XYZ limited company of shares. Or you can think of it that there is an electronic transmitter which communicates your message actually. And then once the transaction has taken place, everything is declared. Okay, it can skip market forces and get a price that is better suited to both buyer and seller. The trade is only announced once it is completed. They prevent signals reaching the market in order to minimize large fluctuations in the share price. This is done because when significant volume of shares is involved in trading, even a small change in share price can translate into a lot of money. Dark pools and a lack of transparency defeat the purpose of fair and regulated markets with large number of participants and threaten the healthy and transparent development of these markets. So basically, the last point is a disadvantage, because dark pool, if everyone is trading in a dark pool, the purpose of the stock exchange is defeated. It is just like a private trading or something, correct? So in some countries, there is a strong control that dark pool does not take place. Because for the general public, it might not be very advantageous. Someone who is looking for to grab an opportunity with a very little investment is not involved over here. From the angle of the two giants, it is good for ABC and for DEF. if you look from the perspective of these huge giant companies, it is good. But for someone who was looking for an opportunity to go into the market with a very, very less amount of money will obviously suffer in this system. Now, again, you might be asked to write around for 4 or 6 marks about dark pool trading system. So if you remember these 4 bullets, you will be able to reproduce the bullet points. And these are the bullet points that you need to learn. This is part of your syllabus, asked in theory for 4 to 6 marks. No computation is asked, but we never know. Very rare chances that a computation might be asked, but this is asked in theory only. So you can learn these points and you can learn these 4 steps. God forbid if they ask some computation which is very, very, very remote, but still one must know about this as well. Okay, Sujit, how will a buyer know that there is a seller of shares in a specific company in dark pool? You can say, for example, let's say you are entering into a dark room, and when you enter, you just mention it on the door or mention it via an electronic signal. Just your identity is confidential. Obviously, you need to declare what you are trading, which company shares you are trading, but the identity of the seller is not disclosed till the transaction takes place. Because if the transaction is not go, for example, does not take place, so no one knows who was the seller and the buyer. Okay, but obviously, definitely there is a signal that, let's say, ABC will not tell that I am ABC pension fund, but they will tell that I have some quantity of XYZ that I want to sell. And the buyer is going to say, I am someone who wants to buy the shares of XYZ Limited. They will not disclose they are DEF pension fund. Okay. So this is all about dark pool that you need to know. Again, as I said, no more details, no in-depth study is needed. In many places, it is not allowed, and it is not something that is developing or being encouraged publicly, but it is something that is part of your syllabus. So you must just have a knowledge of what is a dark pool actually. Yes, we can say that. Okay. All right. So this was the second thing that I wanted to discuss. I hope that my pace is not a pain for someone, but I have to be like this today to make sure that we have discussions of majority of the syllabus area or a lot of things. Okay, moving to the next thing that I wanted to discuss today, and it is about the repayment of loan structure. So I am going to provide this dark pool file to all of you as well. In fact, I have did that already, but if you don't have this dark pool file, you must take it from me. It is a topic that is pending now. Okay, ACCA used to test 4 or 6 marks of dark pool theory, but when I talk about last probably some attempts, dark pool has not been tested. So you have to have a grip overhead, and you can expect 4 to 5 marks from this area, as well as the Modigliani and Miller model that we just discussed. Now let's move to the third area that I wanted to discuss today, and this was tested in your June 2015 exam paper. This specific thing is about loan notes, and these specifically are those loan notes in which there is an annual payment. Okay, so again, a very critical area, a very important area. This is the third agenda for the day that we are going to discuss right now. A very, very important area, and you have to be very careful over here. You need to understand the difference between what is going on in this specific question and what other questions talk about. Let me read the lines that are mentioned in front of you. It is saying $30 million loan in the form of an 8% bond on which interest is payable annually based on the loan amount outstanding at the start of each year. So number one, the amount of loan is 30 million. Number two, the rate of interest is 8%. Number three, the interest rate is applied to the pending, payable, or the remaining amount only. So for example, if during the year there is some repayment from 30 million, for example, you borrowed 30 million, but you repaid 3 million in the first year, the interest is going to be calculated on the 27 million amount only. The bond will be repaid on the basis of fixed equal annual installment or payments constituting of interest and principal over the next 4 years. This is extremely critical. It says the bond will be repaid on the basis of fixed equal annual installments over the next 4 years. So over the coming 4 years, there is going to be a fixed amount being paid back. And that particular amount will include interest and principal as well. Okay. There is effectively another way of taking a loan in which you annually pay interest, and at the end of 4th year, you pay back loan. But over here, we are dealing with a different scenario, a different case. It is not a case where you pay annual interest and principal repayment at the end of the term. Over here, you are making annual repayments, and those repayments include interest as well as principal, both the things. Both are included in it. Okay? Are we clear? So over here, for example, let me draft some cash flows. Over here, the case looks like this. You borrowed 30 million, or let's say the bondholder paid you 30 million. Okay, from the bondholder's perspective, it is an outflow, and the bondholder is going to receive amount X at year 1, 2, 3, and 4. It is not annual interest. It is not like at the end of first year he will receive interest, at the end of second year he will receive interest, at the end of third year he will receive interest, and at the end of fourth year he will receive interest and principal. No, it is that at the end of first year he will receive an X amount. This X amount will include some interest and some original principal. Then the second amount will also include a component of interest, a component of principal. The third amount will also include a component of interest and a component of principal. And the fourth amount will also include a component of interest and a component of principal. And at the end of fourth year, entire principal will be repayment regularly during this journey of 4 years. So this is something very different. Again, this is due to be tested, not tested in recent times, but yes, it has been tested in the old past papers and is part of your course area. Now, what you have to do over here, you have to remember that market value of a bond is equal to present value of all future payments. Okay. Whatever is the market value of a loan, market value of a bond is equals to the present value of all the future repayments. Over here, we have 4 repayments, 1, 2, 3, 4. And the market value or the today's value is 30. The market value, today's value is 30. This is given to you. And these are the repayments that are going to be made in the future. Now, rate is 8%. Okay, rate is 8%. So if I compute the discount factors using 8%, if I compute the discount factors using 8%, how do we compute discount factor? First discount factor can be calculated as 1 divided by 1 plus 8% power 1. Second can be calculated as 1 divided by 1 plus 8% power 2. Third can be calculated as 1 divided by 1 plus 8% power 3. Fourth can be calculated as 1 divided by 1 plus 8% power 4. So if I calculate each of the discount factors and I multiply it with the respective repayment value, so this gives you the present value of all repayments, and this must be equal to 30 million. So we can form an equation of this type. 30 is equals to 0.926x plus 0.57857x plus 0.794x plus 0.735x. And if you calculate x, your x amount is 9.05258, or if you don't round it off, it is exact, in exact terms, it is 9057623 Okay. So the first method to calculate the X amount is that you draft this type of table. Now, since the yearly amounts are same at the end of first year, at the end of second year, at the end of third year, at the end of fourth year, since the all amounts are same, we can say that it is forming an annuity. Annuity is formed when the amounts are same, correct? So we can calculate the annuity factor at 8% for 4 years. To calculate annuity factor, you can either use the formula, that is 1 minus 1 plus 8% power minus 4 over 8%, or otherwise you can sum up the year 1, 2, 3 and 4 discount factors, or you can use the annuity table as well, which is given over here. Okay, I am going to answer your doubts after a couple of minutes once I have explained everything. So this is the third type of calculation of annuity factor. Rate is 8%, years are 4. So this is 3.312. Now, using the annuity factor, you can also calculate it, and it will be loan divided by annuity factor. Loan divided by annuity factor gives you the repayment amount. Okay, before moving forward, let me look into some of the questions we have. When can we use a formula to calculate the market value when we know the cost of debt? Yes, if you are asked in a question to calculate market value of a bond, you can use this formula. If, for example, you are supposed to calculate the annual repayments and you know the market value, you can still use the formula and equate it with 30. Okay, why you added all the discount factors together? Okay, when there is an annuity, do you know what is annuity? In case of annuity, we can add all the discount factors together as well. If we talk about annuity, in case of annuities, we can add all the discount factors together and multiply them once only. Okay. For example, if you separately multiply everything and then you add these together, your answer will be exactly same as 3.312x. So if someone is calculating an annuity factor and multiply it with once with x, this gives you the same answer. Okay. So this X gives you the amount of annual repayments that are being made, and you must know that this includes interest and principal as well. Now I have made a small chart. Okay. The loan amount was 30 million. At 8%, interest is 2.4 million. As per our calculation, repayment is 9057624. So the closing balance is 23342,376. Loan plus interest minus repayment, which includes the repayment of interest as well as some part of loan. And if we carry it over a 4 years period, you can see that it comes out to be 0. Okay, how do we use spreadsheet functions? Okay, we are going to talk about that as well. So how many of you are clear with this specific concept? Okay, we have one more question. If we repay principal and interest every year, how does the bond work? There won't be any repayments left after the first installment and principal is paid. No, principal is not fully paid. Over here, it was written that each of the annual equal repayments will include some component of interest and some component of principal. So for example, at the end of first year, when you paid 9057624, this 9057624 included 2.4 million interest and rest was your principal. That's why your loan amount decreased from 30 to 23.3 million. Second year again, 9 million was repaid. 9 million included 1867 of interest and the rest was the repayment of the loan. So you were left with 16,152. Okay, is there any other method to calculate annual repayment amount? No, you have to use the annuity factors. This is the only way that you do it. when the question is something like this. Okay, how many of you are clear about what we have discussed till now? Okay, now what we will do is that till now actually we have discussed 3 or 4 different concepts, and since we have discussed in these in a hurry, we must take a 5 minutes break to make sure that you all absorb what we have studied or what we have discussed till now before moving to the next concepts. What I actually want all of you is that you all have the support staff number. Do you all have support staff number with you? Please ask support staff to add you to the public WhatsApp group, and also please WhatsApp me so that on my number so that we are connected. We are going to come back after a 5 minutes break. Okay. I am meanwhile sharing some files with you. Till now, what we have discussed, till now we have discussed dark pool trading system. Till now we have discussed loan repayment when there is annual repayment, which includes interest and principal. Till now we have also discussed M and M proposition number 2 and how and when to apply it. Okay, then there is a video on VIFHE YouTube which you must watch. The video is about discounting cases. Okay, I shared link with all the students 1 week back. I hope you all have watched that lecture. If you have not watched it, you can watch it later. It is a 40-minute session, okay, which you must watch. And then there is something known as Dutch auction. How many of you are aware about Dutch auction as well? Are you guys aware what a Dutch auction is all about? There is a video about Dutch auction as well on YouTube. So once you WhatsApp me, I'm going to share that content with you. I'm going to share these 5 contents with you. Actually, what I want is that we cover these concepts before moving on. We take a 5 minutes break. In the 5 minutes, you will be able to look into the files once again so that you get an idea about what we have studied till now, what we have actually completed till now. Dutch auction is available on the VIFHE YouTube. Then there is a session which discusses the different scenarios of discounting. These are the problem areas that students find very difficult to address. Okay, so you can go to the VIFHE YouTube as well, and your Dutch auction will look something like this. If I talk about Dutch auction, the Dutch auction thing is something like this, which you can watch. And then there is a discounting video as well, which you can watch after the session. So we are going to come back. Okay. And those who are not connected with me, make sure you WhatsApp support staff so that support staff adds you to the public group where I am going to share all this. All right. So we are going to come back after 5 minutes time. We are going to come back after 5 minutes time and discuss things further. You all must WhatsApp me before we proceed. These are the 2 sessions that I am talking about, and above are the things that we have already discussed. Okay. So anyone who sends me WhatsApp, I am going to share these files with you. I hope you all are in the groups as well. All right. So shall we proceed now? Let me look into the chat box. Is it possible to keep session after 8 p.m.? Majority students find comfort. Tahir, I guess the schedulings are done, so it will be very difficult. We are going to complete 5 points today. Abdullah, let's see. We have already done these 5 points, I believe. So let's move on. Let's see what else we can do. And I have broadcasted the relevant Excel files to each one of you who was in my broadcast list, and also shared with a lot of people on the WhatsApp groups as well. If you have not found it, you have to let me know or check the relevant WhatsApp groups if you are part of those groups. In case you are not part of any group, you have to make sure that you are part or you join those groups. Okay. So shall we proceed further, or do you guys want 1 or 2 minutes to complete to review the content? So these are the 5 points. These are the 5 points. The first one, dark pool trading system. We discussed it today. We discussed the loan repayment schedule. Obviously, you have the recordings. You can go through the recording and the files again. And this is very important. I believe this is going to be tested. Super important, I believe. So be very careful. Do it very properly. This is something that is very important. And then I discussed that there is one session which says how to deal with different discounting scenarios on VIFHE's YouTube. If you are not good at discounting the things and calculating the discount factors, and then the Dutch auction. Okay. For M&M application or proposition number 2, Triple Time Company is a question which tested this. Okay, so shall we move forward? All good? All right. Now let's discuss the ticks. Okay. Sir, by when you are sharing a list of by tomorrow night, I will share the secret sauce by tomorrow. Okay. All right. Let's move further and let's discuss the remaining things afterwards. Now, I want you all to focus on a past paper question, and the past paper question is June 2015. I hope you all also have the past papers with you. So there is a past paper question with the name Dicon Company that I want to discuss with all of you. Okay. So let's discuss Dicon Company, and this question is also on the portal actually, but there is a margin requirement from this question that I want to discuss. And then there is tick size, and then there are collars. Okay. So collars, margin, and tick size, everything is in this single question. So that's why we are discussing this as well. Shall we start? This is June 2015 Dicon Company. We will see the treatment of collars. We will see the treatment of margin requirement. We will discuss uh, tick size using this question as well. So this is all that we are going to do. Okay. All right. Let's discuss the things. How does the question start? So the question is saying, for a number of years, Dicon Company has been using forward rate agreements to manage its exposure to interest rate fluctuations. Recently, its Chief Executive Officer CEO attended a talk on using exchange traded derivative products to manage risk. She wants to find out by how much the extra cost of the borrowing detailed below can be reduced when using interest rate future, options on interest rate futures, and a collar on the options. To manage the interest rate risk, she asked that detailed calculations for each of the three derivative products be provided and a reasoned recommendations to be made. Dicon Company is expecting to borrow 34 million in 5 months' time. It expects to make a full repayment of the borrowed amount in 11 months' time. So the things that you need to note is that the total borrowing amount is 34 million. Okay. And borrowing will take place 5 months from today. And it will end 11 months from today. So what is effectively the borrowing period? For how long, the borrowing is taking place? 6 months. Agree. Assume it is 1st of June 2015 today. So if it is 1st June 2015 today, and if the borrowing is going to start after 5 months from today, so the borrowing is going to start June, July, August, September, October, end of October, that is 1st of November. Okay. Dicon company can borrow funds at LIBOR plus 70 basis points. LIBOR is currently 3.6%, but Dicon company expects that interest rates may increase by as much as 80 basis points in 5 months' time. So right now, LIBOR is 3.6%, and it is expectation of the company that it will move up by 80 basis points. When we talk about 80 basis points, this means 0.8 will be added to 3.6 and it will move to how much? 4.4%. Agreed? And further, you have to note that a company can borrow at LIBOR plus 70 basis points. So right now, 3.6 plus 0.7, company's borrowing rate is 4.3%. But if the LIBOR increases by 0.8%, so it will go up to 5.1%. Do you all agree? Do you all understand this? Okay. All right. Now, you don't understand or do you understand it? Currently, what is happening? The borrowing rate is LIBOR plus 0.7. So if LIBOR is 3.6, 3.6 plus 0.7 is 4.3%. But if LIBOR increases by 0.8, it will be 4.4. So 4.4 plus 0.7 will be 5.7%. So there is going to be an increase. The following information and quotes from an appropriate exchange are provided on LIBOR dollar-based dollar futures and options. 3-month dollar December futures are currently quoted at 95.84. The contract size is 1 million. The tick size is 0.01% and the tick value is $25. Now, many of you might have completed this question from your portal as well. But today, what I am going to do in this question is to let you know how do we treat the tick size and tick value. Although it is a big rubbish, but we need to understand this big rubbish as well. So anyways, the first thing to go is about the futures, and then you have options on 3-month dollar futures. Again, you have some details about it. Initial assumptions, it can be assumed that settlement for both the future and option contracts is at the end of the month. That basis diminishes to 0 at constant date until the contract matures, and time intervals can be counted in months. That margin requirements may be ignored, and that if the options are in the money, they will be exercised at the end of the hedge instead of being sold. And then we have some further information as well. So the requirement of the question was which hedging tool is good for us. Okay. All right. Let's do it for futures first. What will be our strategy? This case is for borrowing, correct? In case of borrowing, what are we worried about? We are worried that interest rates will increase. And we know that if interest rate increases, what decreases? If interest rate increases, futures price decrease. Okay. So right now futures, if interest rates will increase, future prices will decrease. Right now futures are expensive. Later they will be less expensive. So the strategy is sell now, buy later. Correct? We have discussed this strategy several times. Yes, go short or sell now, buy later to close the deal. Now, as far as number of contracts are concerned, your borrowing amount is 34 million for a 6 months period, but the future contracts are for 3 months each. So how can you find the number of contracts? 34 divided by 1 multiplied by 6 over 3. Agreed? Tell me how many number of contracts will we go for? 68. Correct? We will go for 68 contracts. Are we all together? Okay, you all must have the question paper with you open on a separate device. Correct? You all must have the question paper open with you on a separate device. It is something that is available on the Google Drive as well. So I've summarized things over here. Today is 1st of June 2015. Borrowing starts from 1st November, that is 5 months from today. Repayment is on 1st of May, that is 11 months from today. Amount to be borrowed is 34 million. Normal borrowing rate is LIBOR plus 70 basis points, that is 0.7. And currently LIBOR is 3.6. Expectation that interest rates may increase by 80 basis points. So LIBOR will become 4.4. 3-month dollar December futures are currently quoted at 95.84. This was given to you in the question. Contract size is 1 million and tick size and tick value is also given. Okay, so this information is from your question, which I have summarized over here. Now use futures to hedge the above scenario. We discussed that sell now, buy later will be the appropriate strategy. Selling now at a higher rate and buying later at a lower rate. So current borrowing cost is 73,100. Let me show you how. 34 million multiplied by 6 over 12 multiplied by 4.30%. Correct? Borrowing cost if interest rates increases, if interest rates increase, if interest rates increase, if interest rates become 4.4%, increase by 8%. If your LIBOR increases by 0.8%, so you will have to pay 867,000 and the additional borrowing cost is going to be 136,000. Do you all agree with these workings? Anyone with any sort of confusions can let me know. Okay. All right, let me repeat. Let me know which specific area do you want me to repeat. Can you explain LIBOR? LIBOR is London Interbank Offer Rate, the rate at which one bank exchanges funds with another. Yes, Tejani, I am going to share this file on Excel as well. Did you get the previous 3 or 4 files that I shared? Please do get added into the AFM broadcast groups. Okay. In this area, everything is as per the question. Date today, borrowing starts on 1st November, borrowing ends on 1st November. May amount is 34 million. The question stated that today's rate is LIBOR plus 70 basis points. LIBOR is currently 3.6% and it is expected that it is going to increase to 4.4%. The futures are available in the market today at 95.84 and contract size, tick value, everything was given in the question. Over here, we calculated what is the cost today. The cost today is 4.3%. 4.3 is your 3.6 plus 70 basis points. 34 million is the amount and 6 is the number of months for which we are taking the borrowing. And if the LIBOR increases by 0.8%, you will be able to get the same amount of funds and you will need to pay 867,000. So additional borrowing is 136,000. Okay. 5.1% is the new borrowing rate. Current LIBOR is 3.6%. If LIBOR increases by 0.8, it will move to 3.6 plus 0.8 is 4.4. I can borrow at LIBOR plus 70 basis points. So 4.4 plus 0.7 will be 5.1%. Okay, why are we calculating the additional borrowing cost? Is because in the question it was stated that you have to show the hedging instruments and let us know that how will hedging help to actually to counter this additional borrowing cost. It was mentioned in the question. Okay, number of contracts calculation is coming ahead. Let me explain it. First, read this line. It says, as we are borrowing, we are worried that interest rates will go up and we will have to pay more interest cost. Remember that interest rate and interest rate future prices are inversely related, so we go short in the futures market. Going short means sell today and buy later. If interest rates go up, the future prices will go down. So effectively, we will make a gain selling today at high rate and buying later at a lower rate to make gain. In case of deposit, the mechanism is opposite. So do identify the case in your question. Okay. After this, we have calculations of number of contracts, but we are going to first discuss if everything till now is clear. Okay. Do you guys need break to absorb whatever we have discussed till now, including going through this file and the other files? Do you guys need some time to absorb all the concepts done till now? No? Okay. Now, the next thing is the calculation of number of contracts. It says, do notice question wording for time period of contract. In this question, it is mentioned the time period for futures is 3 months. This is mentioned in the question and this is important. So your future period is 3 months, but borrowing period was 6 months and the borrowing value is 34 million and contract size is 1 million. So in order to calculate the number of contracts, 34 million divided by 1 million will give you 34. But these 34 contracts will cover a 3 months period only. For 6 months, you need to multiply it by 2 or multiply it by 6/3. All good? Quickly, you will get these Excel files. You just need to understand the things. I am more comfortable calculating without tick size. Will that affect my marks? Everyone is more comfortable doing a question without ticks, but we must understand the ticks and the tick size and the tick value, because you never know the examiner. Maybe examiner will say, solve the following question using the tick size and the tick value only. What will you do in that case? So you need to know the tick size and the tick value, correct? Okay, now once we have calculated the number of contracts, it is very simple, same that we used to do in the normal classes, that you take the interest rate today. Your LIBOR was 3.6%, so 100 minus 3.6 is reflected as 96.4. Your futures price given in the question today is 95.84. So the difference which is known as basis is 0.56. Then basis diminishes to 0 on contract maturity. 95.84 were December future contracts. So you proportionate it and you simply calculate. This reflects the new interest rate. If interest rates go up by 0.8%, 3.6 will convert into 4.4. So 100 minus 4.4 is 95.6. This is the unexpired basis and this is obtained as a balancing figure. This is expected future price on 1st November. Do remember that in real life this may differ. Okay, all good till now? This is the same table that we have made several times previously as well. Those who have actually completed the lessons may know that this is how we do things. After today's class, you will also do this June 2015 question again, Dicon company, and then there is one more question. Okay, you want me to explain this basis? Okay, basis at 1st June are 0.56. They will become 0 on 31st December. So June, July, August, September, October, November, December. 0.56 will become 0. 0.56 will become 0 in 7 months. Correct? 0.56 will become 0 in how many months? 7 months. So if 0.56 becomes 0 in 7 months, you will divide 0.56 by 7. You calculate the monthly decrease, and then on 1st November, 2 months are remaining. 0.56 divided by 7 gives you 0.8. At 1st November, 2 months are remaining, so 0.08 into 2 will give you the remaining unexpired basis. Okay, so this is the expected futures price. Now what you do is that gain in the futures market, method number 1, without using the tick size. Sell now, buy later, this is the gain, and then this gain is converted into total gain. So 0.4 is a percentage, so we divide 0.4 by 100. C32 is the number of contracts. C32 is probably the number of contracts into 1 million, which is the value of one contract multiplied by 3 over 12. Okay, this is the normal way we do. This is the way we calculate the gain or loss in the futures market regularly in our all the questions. Yes, Ritik, you are right. Over here, the lock-in rate is giving us the futures price. Okay. Are you all clear? Are you all clear about the gain? This is how we used to do the question. Okay. And then there is a note as well which says gain is in percentage, so we divide by 100. There are 68 contracts, so we multiply by 68. Value of each contract is 1 million, so we multiply by 1 million. Time period of each contract is 3 over 12, so we multiply by 3 over 12 as well. This is the normal way we used to do. Now method number 2, which is involving ticks. Ticks is nothing but a pain. Ticks is nothing but a useless thing, but we need to understand it. Okay. Now in the question you were given tick size of 0.01%, tick value of $25. These two values were given in the question. What if the question told you that you have to solve the question using ticks and the tick value? How will you do this? Okay, tick size is 0.01%, which is 0.0001. This tells you the smallest possible movement in the value of a future. What is tick size? Tick size is the smallest movement. Tick size is the smallest movement in the value of a future. Tick value of $25 tells you how much gain or loss will there be for one tick movement. So if the movement is 0.01% and tick value is 25, this means that if the interest percentage moves by 0.01%, there will be a gain or loss of $25. Okay. So for example, if future price changes from 95.84 to 95.83, or the change is 1%, the change is 1%, this is movement of one tick. We call that there is a movement of one tick. If futures price increases by from 95.84 to 95.83, we say that there is a movement of 0.01%, and this 0.01% movement is known as one tick. Okay. So for example, if someone sold something at 95.84 and bought it at 95.83, they can say that they made a gain of 0.01, or they made a gain of one tick. Okay, this 0.01 is percentage, correct? So we can say a movement of 95.84 to 95.83 is a movement of 0.01%, and 0.01% is equivalent to one tick. So the gain is going to be, the total gain of this movement is going to be 25. Okay. What is tick size? Tick size is the smallest movement in the value of the futures. Tick value is by how much there will be a gain or loss due to movement of one tick. Now in our question 95.84 was moving to 95.44. So if 95.84 futures price move to 95.44, sell at 95.84 and buy at 95.44, the difference is how much? 40, correct? 0.40. And if each tick is of 0.01, can you say that the movement is 40 ticks? Correct? We can say the movement is 40 ticks. Like the thing has moved by 0.01 40 times. 0.01, 0.01, 0.01, 0.01, 0.01, 0.01, 40 ticks. Correct? Tick is a movement of 0.01. So the total movement is 40 ticks. Now what we do, once you calculate that the total movement is equivalent to 40 ticks, each tick is valued at 25. So your total gain per contract, your total gain per contract is going to be 40 into 25. There are 68 contracts, so you again come up with 68,000. Same answer as per method number 1. Method 1 and method 2 give you the same answer. Are we all clear? Any problem? Okay. So this is basically how the ticks work out. I will give you this file as well. You will go through this file. Okay. And understand how we did calculations over here. All right. Any issues in this? Again, tick is rubbish, useless. Don't use it unless the question tells you that you have no other option but to solve using their ticks only. Dividing the gain by 400 is also acceptable. 400 is a sum of two things, 1 over 100 and 3 over 12. 1 over 100 represents percentage, 3 over 12 represents number of months. 1 over 100 into 3 over 12 is 1 over 400. Did the question is always the same? Okay. Does this mean that when they give tick in the question, it always gives the same answer as not using tick value? Yes. The tick value questions answer and the tick values answer will be same. You solve it either way, your answer will be same. Okay. So I hope that this is clear by now. Once you go through this file once again, you will be in a much better position. With the practice, you will be able to do it very properly. Don't be worried. Okay. Do go through this file as well when I share it with all of you. Okay, now the next thing that I need to discuss is about the margin requirements. So let's discuss the margin requirements in a minute. And again, I am going to share the file which you can review. And when you review, you will be able to understand the things. Okay, in the same question, Daikon company question, there was a part about the margins. So let's discuss this specific part now. This was about the margin requirement and everything. Futures price will be marked to market daily. Margin requirement is actually a very small deposit that you have to make. Okay. Margin is a very small deposit amount that you have to make with the dealer. It is just like a security deposit. Okay. It is just like a security deposit that you have to give. So it is saying that future contracts will be marked to market daily. The CEO wondered what the impact of this would be if 50 future contracts were bought at 95.84 on 1st of June and 30 future contracts were sold at 95.61 on 3rd June. Based on the December dollar future contracts given above, the closing settlement prices are given below for 4 days. So for example, on 1st June, the value is this. On 2nd June, this is the value. On 3rd June, this is the value. On 4th June, this is the value. Now, you have bought one contract for how much? You have bought one contract for 95.84. On 1st of January, on 1st of January, you bought a future contract at 95.84. On 2nd January, the value decreased to 95.76. So if there is a decrease in the value of what you purchased, is there a gain or a loss? Obviously, there is a loss. You bought something at 95.84. Now it is worth 95.76. So there is a decrease of 0.08, suggesting that there is a loss of 0.08. Agreed? And your total loss will be 95.84, 95.76 difference divided by 100, because these values are in percentage, multiplied by 50, multiplied by 1 million, multiplied by 3/12. Why 50? Because in this example, the question stated that assume you bought 50 future contracts. So if I bought 50 future contracts, so it will be 95.84, 95.76 difference divided by 100 for percentage, multiplied by 50 because there are 50 future contracts, multiplied by 1 million because the contract size is 1 million, multiplied by 3/12 because this is the time period. Do you all understand that on the first day there will be a loss of 10,000? If I mark to market my product daily, I bought something at 95.84, but now it is valued at 95.76. So there is a total loss of 10,000. Understood? Understood this thing? Please, I need participation. Okay. Now this was the loss on first day. Okay. Then what is happening on 3rd June? 3rd June, the prices are decreasing to 95.66. They are further decreasing downwards. Okay. 3rd June, the prices are decreasing downwards. So there is a loss from 95.76 to 95.66. One loss is this, the decrease in the value, and there is one more loss. What is one more loss? One more loss is that on 3rd June, you are also selling. On 3rd June, you are also selling 30 future contracts. On 3rd June, you are also selling 30 future contracts at 95.61. So you are making two losses. Number one, there is a decrease in the value of everything. So 95.66 minus 95.76 gives you the amount of loss, divided by 100 because this is in percentage, multiplied by 3/12 because this is based on 3 months, multiplied by 1 million because the amount is 1 million, multiplied by 50. So first, the decrease in value, the loss due to decrease in value is how much? It is 12,500. And then there is one more loss because you are selling something which is with you at 95.66, you are selling it for 95.61. So there is one more loss. So the total loss is 16,250. Understood? There are two losses over here. One due to reduction in the value, and second due to the selling. Okay, let me show you the loss of 3750. You sold something at 95.61, which was valued with you at 95.66. So you made a loss of 0.05 per future, divided by 100 because this is in percentage, multiplied by 3/12, multiplied by 1 million, multiplied by 30 because you sold 30 future contracts, not every, just 30. You sold 30 future contracts. So your loss must be on 30 contracts only. Okay. Then on 4th January, what is happening? 95.66 is raising. This time there must be a profit. It is going to 95.74. So in this last case, okay, repeat over here. On 2nd June, something was valued at 95.76, but now on 3rd June, it is valued at 95.66. So the value of this product is decreasing by 0.1. So we take the difference divided by 100 because it is in percentage, multiplied by 3/12, multiplied by 1 million multiplied by 1 million into 50. Okay. Good enough. All right. Now, on 4th June, there is a value increase of, why is there a value increase? There is an increase in value because on 3rd June, these futures were at 95.66. They are now trading at 95.74. So there is an increase in value divided by 100 because they are in percentage, multiplied by 20 because out of 50 you sold 30. So you are left with 20 only, into 1 million into 3 over 12. Are we all clear? Then there was one more method which the ACCA examiner used, and some theory about margin requirements which you can read. Effectively, I'm going to give you 2 questions to do right now as the session ends. Do we need to recognize these losses in P&L into daily basis? It depends upon the accounting treatment based on IFRS. Futures are hedging instruments, so you have to check the accounting standards. Okay, you have to do the accounting as per IFRS 9, correct? All right, I am going to share this file with all of you as well. I'm going to share this file with all of you as well. Are we clear? Okay, what was more on the agenda was the SPACs. Okay, and the dividend valuation area is very easy, I believe. So let's move to the SPACs area. After that, I'm going to give you all 2 questions to solve right now, right today, which you will do right now, right today, and then we will do further discussions. Why are we calculating again as we sold on 3rd of June? We did not sell all the futures on 3rd of June. We sold 30 out of 50 that we had. Okay, we sold 30 out of 50 that we had. Got my point? Okay, what was the purpose of calculating a margin? What question is it answering? Okay, we were doing this June 2015 question. The purpose of the margin is that you make a security deposit. It acts just like a security deposit when you are trading in the futures exchange. Because in the futures exchange, for example, if you keep on making unrealized loss, there are chances that you will run away, correct? So in order to actually minimize the chances of you running away, what happens is that the dealer asks you to give you some, dealer asks you to deposit some funds. All right. Let's move to the other side now, which deals with SPACs. Okay. As I said, I am doing things in a hurry so that we cover maximum in the minimum possible time. And then once the session is over, I am going to provide these files to all of you. You can review them, go through them, and you do the questions that I will provide. And we can rediscuss things after a couple of hours. Okay, now this is one more thing. This is specs recently added to your syllabus area, theoretical area, which you must know. So what is specs? It states that these are special purpose acquisition companies, special purpose acquisition companies. Okay. So these are the companies specially formed to acquire another company. They don't have their own business. They acquire another company. They are going to acquire someone else. Okay. They were formed to collect funds, gather funds, and acquire someone else. So what are the steps? Step number 1, spec is formed by sponsors. Sponsors are professionals with relevant industry experience and provide initial capital. So for example, let's say we talk about some industry. Let's talk about the, you can say, pharmaceutical industry. So some doctors gather together, they arrange some funds, good handsome amount. Okay, they all are experienced individuals of maybe 20-30 years of experience, and they gather funds. They collect funds together, and they provide an initial capital to form a SPAC. What is a SPAC? It is a company, but it is a special purpose company, and the purpose is to acquire someone else. The company will not have their own business, rather they will acquire someone else. Step number 2, SPAC raises money through initial public offer. Then there is initial public offer. Through initial public offer, there are more funds pouring into the company. Okay. Objective is to raise funds to buy another company. As a SPAC, you will not do your own business, rather you will buy some other company. So for example, if you are talking about pharmaceutical company, these doctors knew about a company that was very popular, very profitable, and doing a business, a very handsome or a very good business. So they decided that they are going to purchase that company by forming a company of their own. Important thing to note is that at the time of IPO, SPACs do not have business operations or stated targets for acquisition. SPAC units trade like stocks. Investors can buy or sell shares for the current market value. Step number 3, money raised goes into a trust. Trust invests the funds in money market funds or other suitable places. Unless the funds are needed, unless the funds are utilized, unless the funds are going to be used to buy a potential target company, obviously we cannot keep this huge amount idle. We have to make some earnings, correct? So until the date that the funds are actually used to acquire someone, these will be placed somewhere so that there is a suitable gain to match the expenses and everything. Sponsor search for a suitable target company and acquisition is completed. A SPAC has a limited time period, typically 24 months, in which to complete the SPAC, identify a target operating company, and conclude a business combination. Now, those intelligent, smart group of doctors, they find a suitable target using the funds that are collected from the investors. They buy that particular company. Generally, the whole process needs to be completed within 24 months. If it takes more than that, you need to refund all the cash to the investors. Sponsors search for a suitable target company but are unable to acquire it. What if they search for some company, but due to some reason they are unable to acquire any target company? The funds held in the interest-bearing trust account are either returned to the shareholder or a sponsor seeks shareholders' approval for an extension. Again, I must say that this is a theoretical area, a new area. It can be tested, but you need not to be worried if you have this handout and you have read it a couple of times. For example, if it comes out for 4 or 5 marks and you write these 4 points, I believe you will get all the marks that you need to gain. Okay, these files will be sent as well. All the files are on Google Drive as well. But still, I will be sharing these files with all of you right after the session ends. So is there anything else that you guys want me to discuss, or shall I proceed? No, Haris, it is not in the 67 pages booklet because it is a very, very newly added portion, like something which was added last year. So it is a new thing. How can a spec be traded? It does not have a value on its own. What do you mean by traded? Units of a spec? Okay, generally it is very difficult initially to do valuation of those shares because they don't have any operations, but still the funds are present and the funds are invested in some place from which they are generating an income. So in itself, the value of the specs will not be too much, it will be very less in comparison to someone who is doing an operation, but obviously there is a cash in the company and that is invested and that's earning as well. Yes, I will be sharing this specs in the group as well. Okay, shareholders can be anyone because there is a proper IPO, so anyone can become a shareholder. But generally, the starting or the initial sponsors are those who are expert of the industry. They have a knowledge of a company because 24 months is not a too much a long time. So they already have a plan. Generally what happens is that individuals of a similar profession gather together, they already have some company whom they think is a good company, is running a very well business, and it is maybe a private company. So what they do, they form a public company and they acquire that particular private company. Okay, again, keep things simple, don't go into too much details. ACCA is not expecting you to know a lot. And so must be the majority shareholders, most likely yes. Okay, all right. So as per the agenda, we have discussed most of the things for the day. Obviously, you all will need to go through these files and you will need to recheck your knowledge about dividend valuation. I am going to provide a short Excel working. Now, what I want all of you to do right now, what I want all of you to do right now is to actually make sure that the June 2015 past paper is done. Oh yes, uh, okay, dividend valuation I will provide. What I want all of you, you all have the old ACCA past papers, correct? Old ACCA past papers. You all have those old ACCA past papers. In old ACCA past papers, go to June 2015. In June 2015, there are two past paper questions that I want you all to solve right now in coming a couple of hours. Session time left is only 16 minutes. So I don't think that I will be able to do entire question, but I am going to share some material with you, which is going to help you solve these two questions. What you want you all is to solve June 2015, June 2015 question number 3. Okay, you all solve June 2015 question number 3 and June 2015 question number 4 right now. Apart from that, today you must make sure you know what are specs, what is Dutch auction, different cases of discounting. Then you must know about mark to market process. Then you must know about tick size and tick value. Then you must know about M&M proposition. And then you all must know about dark pool. I believe over the next 2 or 3 hours, you need to invest next 2 or 3 hours to go through all the files that have been discussed today and also do these two past paper questions. Oh yes, one more thing, the treatment of loan when repayment is annual. Okay, where do I access the question papers? If you don't have the question papers, you can WhatsApp me, Ritik. I am going to check the WhatsApps. And if someone can do the favor and please share in the enrolled students group. May you get AFM group link. For AFM group link, okay, there are students over here who are enrolled already. Enrolled students are in the paid students WhatsApp group, correct? Then there are some students who are unenrolled, old students, or someone who is a public student. What you can do is that you contact support immediately and ask support to share the public WhatsApp group links with you. Okay, so join that group. Past papers are available on portal. Yes, Tahir, they are available on the portal. There is a tab in starting tabs which says past papers, and at the bottom you will find a file which says 2007 to 2015 question papers and 2007 to 2015 answer papers as well. Okay, kindly share the Excel file. Sure, I am going to share it. Please, can you share the material in the global WhatsApp group? Yes, I have shared it already. If you have not received it, please let me know on WhatsApp which specific group you are part of. How important a technical? Is there a new one published recently? Can find it in ACCA? Is there any? Okay, tomorrow I will issue secret sauce for this attempt. What is secret sauce? You must have heard about the secret sauce from many students who have secured high. Secret sauce is a document which refers to important technical articles. There is a list of what to do's, and then there is a list of questions. There is a list of questions to solve. So there are going to be around 20 past paper questions which you must do as per the secret sauce. I need to update the secret sauce from last time. I will do that and let you guys know by tomorrow. Do you have to submit after doing it? No, you don't need to submit, but just go through both the questions properly and understand everything. And if there is anything that needs to be discussed, let me know. All right. Okay, so thank you so much everyone for the first session. I hope that it benefits everyone, and we have discussed a lot in a very short span of time. So actually there is a need that you all also go through the same contact once or twice and try to understand these 8 or 9 different concepts. These are small concepts. We can expect each one of these to be tested for like 4 or 5 marks maybe in your exam papers. Okay. Thank you. Stay blessed. Bye.